Welcome to Stock Talk with Nico Kritikos. Today we're going to be going over how to value a growth stock. And this is very specific to growth stocks only because you're going to be valuing them a lot different than how you value a value stock. So one thing is that when you value a value stock, you traditionally would use a price to earnings. That's one of the most popular metrics to use because bigger companies are normally profitable and the price to earnings is a good way to measure that. But for these companies we're going to use today, which are Splunk, DataDog, and Palantir, these are all three fast-growing SaaS companies, which is software as a service, but they're all unprofitable. So we cannot use price to earnings. So my second favorite metric I want to use is price to sales because they still have high revenue numbers, okay? And so the first one we're going to look at is Splunk. Splunk is the slowest growing one here. We have 14% this year, 18% next year. For Splunk DataDog, we have 65% this year, 42% next year. And then for Palantir, we have, I think it's 40% this year and then 30% next year. So we'll put these in order of least to most to fastest growing. And if we look at Splunk's things, we can see, so they have a forward price to earnings of 400 because they're expected to be profitable in the future, okay? But price to sales is more relevant. So here is, there's three things we can look at. Okay, there's three things that relates to price to sales. And the first one is going to be relating, if the companies are in the same industry, like what we're doing here, you can just compare them to their competitors, right? Now you have to factor in the fact that Splunk is going to be growing a lot less than a company like DataDog. So they should be trading at a lower valuation. So Splunk has a price to sales of 7. DataDog has a price to sales of 61. Okay, big difference there. That's probably too big of a difference. And so what we can see here now is, so that's one way to compare it. So we can say, like, let's say Splunk is doing what? They're not doing that much. They're not that much slower growth to justify a price to sales that much less. So that means that DataDog's either really overvalued or Splunk's really undervalued. In this case, it's probably DataDog's really overvalued because the price to sales of 61 is insane. So that's one way we can do it. Compare the metrics to their competitors if they're growing at similar rates. Number two thing we can do with the price to sales is one of my tools that I've kind of created, a metric that I go off of is I like to have the price to sale. I like to have the percent revenue growth for the next year to be at least double what the price to sales is. So in this case, if the price to sales is 61, that means I want the company should be doing at least 120% revenue growth, which they're not. And so that's not good. That means it's kind of overvalued. So let's say for DataDog, for example, this company is growing what, 42% next year. That means I would like to see a price to sales of about 20, maybe a price to sales of 20 would be fair. But this 61 is that's way too overvalued. So DataDog definitely needs to come down. Now for Splunk, we can see a price to sales of 7, and they're expected to grow by 18% next year. 18% is more than double their price to sales of 7. So that means that Splunk is in a much more it's a more fair valuation. It's I don't want to say it's cheap. It's not cheap, but it's much more justified. It's a much more, you're getting a much better deal when you buy Splunk right now. So, and then for Palantir, let's see, price to sales of 25. That means they should be doing at least 50% revenue growth. That's a little bit too much. I don't really like that. That means you're paying huge amounts of money. They're next year they're going to do $2 billion of revenue, and you're paying $32 billion for this company. That's quite a lot. That's why, and I am bought into this company. That's why I'm a little bit disappointed, because I've been buying these shares recently. I bought in a little bit too early. I think even at these prices, it's come down a lot, but it's still, I don't know, you're paying a rich valuation, but we'll see what happens. Then the third thing with the price of sales I would like to point out here is, let's see. So we got the third thing would be the price to sales for the company compared to where the price to sales was in the past for the company. So DataDog 61 now, over the past 12 months, 13 months, it's traded anywhere from a 41 to a 56. I mean, it's much lower in the past. So that means, again, that's another sign that points this stock is overvalued. A 61 is much higher than where it was at in the past. That's not good. Palantir, price to sales of 25, that's for where it's traded at in the past, a 35 and a 40. This has come down quite a lot. It's been at a 21 before. That wasn't during the pandemic. So yeah, if you can get Palantir at like a 20, no, under a 20, I would want Palantir at a 15 price to sales. So that would be a good deal then, but Palantir kind of looks overvalued in that metric too. Then we have Splunk. Splunk is trading at a 7, much lower than where it's traded at in the past. That's why this one looks like a good deal again too. So that is how you value a growth company based off the price to sales. Now you can also use things like, you're not going to use anything that has to do with earnings or profitability. So anything has to do with margins, return on capital, things like that, return on equity, return on assets. You're not going to use that. Can't use, well, yeah, enterprise value to EBITDA. That's not going to work. The price to book. I don't really use that one much. I don't think that one's much as relevant. But see, all these, the margins, you can't really use that. So those are the price to sales is the main one you want to use. Now the other thing you could do is you still want to go through the earnings call, go through the 10K reports, and read about the business model, how they make their money, what the future is going to look like, what market share they have in the business, and how much is the industry expected to grow into the future. And so those things are still very much relevant. So like a company like DataDog is another good example. Unprofitable, fast grower, and I think it's very undervalued at these prices. So let's see, price to sales of 7. It's less than half of where it's traded at in the past. Okay. And we want the company to be growing at least 15%, and it's expected to grow 27% next year. So this one's a good deal. The other thing is, a company like this, we can see that they actually bought out Livongo a couple of years ago, which they make medical devices for like, I think $18 billion. And now you're getting this whole company for 12 or 13. So that's another sign that this company is a little bit overvalued or undervalued. I mean, this is undervalued. This is a good price. So yeah, that is the main way you are going to want to value a growth stock, using a price to sales ratio.